Welcome, everyone, to another episode of This Week in Real Estate, hosted by yours truly, a bearded man of real estate. But it's not just me. I've got a special guest today. I'm excited to get to him. We're going to be talking a lot about short-term rentals at the very end of the show. So if you have a short-term rental or you know someone that has a short-term rental, ping them and get them in here because I want to hear their opinion on what the CEO of Airbnb said. So this may be a big deal. Some people are saying maybe it's the next coming crash. So we're going to talk about that. But first, before we get into all this stuff, let me bring up a good friend of mine and fellow gambler, Chris Leeper. What's up, man?
Hey, man. How are you doing?
Look at that. A beard and everything.
Barely qualified. I barely qualify.
Yeah, you're in there. You're in there. That's enough. For those that don't know, we used to have, the show used to be called The Bearded Men of Real Estate, but we changed it to This Week in Real Estate because no one knew what in the world we did with the Bearded Men of Real Estate. Someone actually asked me if we talk about beard oil as real estate agents. I'm like, well, that's a very niche topic. If you're joining us live, we're broadcasting in several different places. We're on YouTube, Facebook, and a couple of different places. Chris is broadcasting on Facebook too, so thanks for doing that. There's LinkedIn, Twitter, everywhere. You guys can comment, and we can display your comment, just like Olivier, who was first today. He's saying even though he's super busy, so I appreciate you joining us there. Matt LaMarche, who was our guest last week on the show, he's also in the chat, so you guys feel free to chat it up, and then we could display your chat and talk about you, or we could talk about what you had to say. So thanks for doing that. We're also broadcasting live in Clubhouse. So if you're joining us in Clubhouse, I think you have to follow the actual house or something. They've changed how it's all done. So now we have a regularly scheduled live in the Real Estate Networking house. So you guys be sure you join that house so that you can comment and participate, raise your hand and come up if you have anything to share about some of these topics that we talk about today. But Chris, can you tell people where you're from and what you do there?
Yeah, I'm in sunny Southern California, more specifically Riverside County. We run a couple of sales teams here. And yeah, just trying to be here to serve my community, do what we can.
How long have you been doing real estate?
Been licensed now for 16 years.
Okay. So yeah, me too. I've been in the game somewhere around 16, 17 years. And we met it was at a Tom Ferry event. That was the first time we met, right?
Yeah, you're airing our dirty laundry, fellow gambler.
Yeah, we were around the roulette tables, and we were. That was when Tom Ferry was bold enough to have 7,000 agents go to Las Vegas, and then he tried to teach them stuff. And what really happened is a lot of networking and people showing up late to the event. So he doesn't have it in Vegas anymore for some reason.
Probably smart, but man, honestly, it was one of the best events that we did. Connected with so many great people: Tim Macy, Chris Kwan, Brian Kochi, just to name a few, and people that we still keep in touch with today. So very valuable around that craps table. Nice.
Yeah, and somebody just said that they couldn't hear. They couldn't hear you in Clubhouse, but I think I just fixed it, right, Olivier?
Check. Can you hear me now?
Yeah. It's good. I had the wrong microphone input. It starts to self-select after a while, so I always have to check that. Well, dude, thanks for joining us
at the final hour. Gotta love
it.
We
did have some. At least you have video. So that was kind of part of the technical difficulty that was having behind the scene just minutes before we went live. But I appreciate you being here. I want to let me show the graphic that we have for this week's show because, and shout out to Christina's, what just happened? Oh, wait, that's the wrong button. Shout out to Christina Smallhorn to help me craft this because she loves the fire. But today's graphic is a beach house set on fire. So if you're an audio listener, it's got a beautiful beach house with me in front of it pointing because we're going to talk about this. And then it's got the Airbnb and VRBO logos on the side, but this beach house is clearly burning. Now, here's the crazy part about this, Chris. That was made with Midjourney. That was an AI generated image. Isn't that wild?
That looks amazing. It's beautiful.
It's so cool looking.
It's beautiful totally as the house can be on fire, I suppose.
Yeah, I mean, that is a good point. It's kind of a dire story, but it's really cool looking.
I'm anxious to dive into that too. I wanted to talk specifically about your little icon logo that you got going there. So
yeah, we'll do it. Speaking of dire straits, let's talk about what's going on with mortgage applications because they may be taking a dip. Mortgage applications stumble as rates leap. Is the market on thin ice? So be prepared to start hearing more and more talks, especially if this continues to happen, about the crash of the coming crash in the housing market. That's generally what happens when this news starts to hit. But it says as interest rates soar to a 2-month high, the housing market continues to face a severe shortage. Mortgage demand is beginning to falter. Last week, mortgage applications to purchase a home declined by 4.8% from the preceding week, representing a 26% drop from the same week a year ago. According to Joel Kahn, MBA economist, buyers are cautious due to the rate volatility and scarcity of for-sale inventory in many parts of the country. He notes that, quote, purchase price applications decreased to the lowest pace in a month. The average contract interest rate, well, I'll skip that part. Interestingly, while Treasury yields remain largely unchanged, mortgage rates saw an increase. Matthew Graham, Chief Operating Officer of Mortgage News Daily, explains that the mortgage rates have generally been struggling versus Treasuries since the Fed ended reinvesting its bond portfolio proceeds in late 2022. He added that the pressure is elevated by the supply of mortgage debt due to the FDIC's various liquidation efforts. Refinancing, which is more sensitive to weekly rate changes, has even seen a steeper decline. Applications to refinance a home fell by 8% for the week, representing a whopping 43% lower than a year ago. So, Chris, is this signs that one day very soon people are going to stop purchasing houses? Or is this just a temporary stay for what they thought was a temporary rate hike?
I think that there's a lot of fear mongering. I think that there's a lot of headlines to drive traffic. They see, as being a leaper, I think I'm an expert in these leap in mortgage rates.
That's very good. Very good.
Again, I think it's absolute nonsense. It's such a small blip, and all the forecasts from the smartest people on this planet are all telling us that those rates are likely going to be heading down in the very near future. So, top of
probably what people are waiting on.
Points. Yeah, you bring in a couple different data points, and this is all fear mongering.
Yeah, to put this in perspective, the rate is currently at 6.57%. It was at 5.49% this time last year. So
that's a little bit more significant, but when we talk like week over week numbers, this really hasn't moved a lot in the last.
It's from 6.48 to 6.57 week over week.
That's a leap, let me tell you.
Yeah. I would agree with you. I think this is a temporary thing. There was a study done that we talked about 2 weeks ago on the show, where most buyers are waiting for an interest rate of 5.5%. If it gets to 5.5%, 78% of buyers said they would purchase, but that's what they're waiting on. So I think people are just kind of taking a step back, maybe enjoying the end of the summer. Isn't this the time of year where people are graduating and that's always kind of been a seasonal slowdown for us locally. So it may be a little bit of that as well.
I think you typically have the spring and summer selling seasons when you actually get a little bit more activity. I actually think that people are getting a little more normalized with the 6.25% to 6.75% interest rate. We're seeing a little bit more people jump off the fence, but I would agree. If you can get sub 6%, I think this market's going to go crazy.
Yeah. And you still have people that have to move because despite the Fed's best efforts, the economy hasn't slowed down much. But we did have some inflation numbers come out last week. So let's take a look at those. So inflation takes a breather. April sees the lowest rate in 2 years. Inflation in the U.S. seems to be taking a breather. The Consumer Price Index, the CPI, increased 4.9% in April compared to a year ago, marking the lowest reading in 2 years, according to the U.S. Bureau of Labor Statistics. This also denotes a fall from the 5% seen in March, marking the 10th consecutive month of inflationary declines. While the CPI remained positive, meaning prices haven't broadly fallen, the rate at which they're rising has significantly slowed. So this is similar to the home price gain slow. The rate at which prices are going up is slowing. So the rate at which prices have risen significantly slowed since 9.1% peak in June of 2022. Economists believe that while we may take another year to reach the targeted 2% inflation rate, we're headed in the right direction. So April saw average price decline in several categories. Grocery prices, for instance, returned retreated to 0.2% during the month. A similar decrease was observed for airline fares, new cars, hotels, household energy. On the other hand, there were notable increases in monthly prices for shelter, used cars and trucks, motor vehicle insurance, recreational, personal care, and gasoline. However, economists predict that the current trend will lead to lower inflation readings for shelter, and average rents have moderated or even decreased over the past 6 months, which is another news story that we're going to talk about soon. The initial surge in inflation to a multi-decade high was a result of pent-up demand and snarled global supply chains as the economy started reopening in the post-pandy era. And also there was just hardly any supply built for those 2 years. It was just so far behind, and we're still behind now. So as businesses hired to rush to hire workers in post-pandemic, wages grew at their fastest pace in decades, nudging employers to raise prices. However, the extreme level of excess demand for workers are easing, which should continue to put downward pressure on overall inflation. So experts are optimistic. Have you seen in your market, Chris, a drastic impact from inflation, or does it seem like people are just kind of going along like they always have been and just complaining about it more? There's a loaded question for you.
Yeah, no, they're continuing to go along as if nothing happened. We're not seeing any slowdown. We have a local lake here in the area. There's more boats on the lake. There's more people traveling around than ever before. So gas prices, I don't think, are slowing anybody down. The looming recession that may or may not ever come is. I just think that people are talking a lot about it, but it's not affecting how they actually do anything. To your previous comment, people buy and sell houses most of the time when it's not market driven. It's a job relocation, family growing, family shrinking. So most of these people aren't making decisions backed on what's actually happening, whether it's interest rate or inflation numbers. They do what they have to do because life happens.
Yeah, they need more space, or they need less space, or they need to move for a job or not. Olivier said inflation ticked up a bit in April here. Here for him is Canada, sparking fear of a rate increase, or at least no rate decrease this year. Yeah, Canada was first to not raise rates. So we've still, the last time the Fed hiked rates in America was 0.25. They did it twice. When I think we did our first 0.25, Canada did zero. Okay. And so they thought that because Canada did zero, maybe America would also do zero, but America did not. So I don't know. The jobs numbers that came out right after the Fed was better than expected. And normally when you see a Fed increase those rates, the jobs numbers go down because they're basically pulling money out of the economy. So the fact that those jobs numbers were better than expected gives me pause to assume that the Fed would pause, I guess you could say. I think we're going to have more positive inflation numbers for the Fed to not do anything. I think this might encourage him to do something even more because the banks seem to be stabilizing. The only people talking about the bank crash right now left are on YouTube. So I don't know. I'm not as confident as some people are that he's not going to do anything. I think a 1/4 point increase to keep things on the downward trajectory. And his goal, he stated, he wants to make housing more affordable. And so far, it's not slowed down housing at all.
Yeah, you touched on a lot of really good points there. And I'm going to bring up one more in regards to how they track these CPI numbers, right? It is very different today than it was 10 or 15 years ago. And so I always struggle with looking at the data because I truly believe that it's always skewed to tell or to project a certain narrative.
The story of the time. Mm-hmm.
Yeah, correct. I mean, you talk about unemployment, it's like an all-time low, 2-3% or something like that. So if anybody wants to go out there and get a job, they can. Let's talk about wage increase. So yeah, I mean, a lot of really good points. I think you're the first person that I've heard that actually thinks that they're going to continue to increase. Maybe pause, but continue to increase. I like it. That's a bold move, my friend. Bold move.
I mean, I don't see the economy roaring back, but at the same time, I don't see it going down as fast as maybe they would hope. They took out one sentence, and the Fed mentioned, like, we took out this one sentence signaling that we may not raise rates. So I think they're hoping to not raise rates.
Yeah.
But
everybody's holding on to that.
Yeah, if housing is still outlandish, I mean, reports last week showed that we are looking at a housing market similar to 2021. And if that's the case, then we're back to multiple offers and homes going up crazy prices. And I just, if the Fed was true to what he said, wanting to kind of square away and correct housing, then I don't see how he could do nothing. He'd have to just keep it high for a long, long time.
Hopefully the Fed's just looking at the last 6 or 8 months, and we've seen this incredible crash in home prices, right?
Yeah.
The world is coming to an end as a result to home ownership and prices. So maybe he's doing his job, and we actually have more affordable housing today than we did 6 or 8 months ago. So leave the Fed rate alone.
Speaking of affordable housing, Christina M. Smallhorn joins us. She says, not this YouTube check. She is not calling for the crash or for the banks to crash anymore.
We better slow things down with that Fed fund rate then.
Yeah, we will see. Well, speaking of things coming roaring back, real estate stocks may be a sign that people believe that real estate will continue to be strong and improve because those stocks are bullish. Bulls run wild. Real estate stocks stage a comeback. So the weather seems to be changing on Wall Street. It seems like the bulls are back in the real estate sector after a long winter of slumping stocks, maybe longer than a winter. We've seen a remarkable rally over the last week. So Redfin shares, for instance, climbed from just over $7 to more than $11, a nearly 50% rise in just 5 days of trading. Opendoor. Now keep in mind, this is a week after we reported all of these losses from these companies. So that's fun. Opendoor experienced a similar run up with its share price soaring nearly 50% from less than $1.50 to around $2.16. Compass, its shares rocketed over 60% in the last 5 days from $280 to $390. OfferPad and Fathom Holdings went up 20% and 27% respectively. It all started in the last round of earnings reports. Both Redfin and Opendoor released their reports on May 4th, leading to gains the following morning. So the articles that we were talking about reported all these losses from these companies, but what really caught the investor's eye is that the losses were less than before. So the losses were less of a loss than they had before. So they've been doing cost-cutting measures, which I feel like we talked about ad nauseum in the fall, all the cost-cutting measures that these CEOs were doing and laying off staff and firing people. It seems to have worked. The interesting thing here is to note is that the same companies had seen their shares peak back in early 2021, only for them to drop significantly over the last 2 years. Yeah, a little bit longer than a winter. The last rally then seems to suggest investors might finally be warming up to real estate again, especially with recent signals from the Federal Reserve about halting the rate increases that we just talked about, or maybe not. The real estate stocks are still well below their 2021 highs, and the future of the market remains uncertain. Nevertheless, this week's rally reversed months of losses and brought some much-needed optimism. So, Chris, do you follow real estate stocks? Is that something you watch, or are you just like, oh, well, they can do whatever they want, I'm just going to go sell houses?
No, I dabble a little bit. I've purchased some of my parent company years back, so I certainly keep an eye on it. Kind of trying to prep for the meeting a little bit too, just looking at what was happening today. And I'll be honest, I don't understand it at all. If we're talking nationally, they're projecting 35, 40, 50% less transactions nationally, but yet these real estate companies that make their money based on selling real estate, their stocks are going through the roof, but their transactions are going to get cut by 35, 40%. I don't understand their projections, and you nailed it on the head with the Fed fund rate likely to be on hold. The projection for the next, foreseeable future, 3, 4, 5, 6 months, I think is optimistic, like you ended the article. But it doesn't make sense to me today.
Yeah, I don't know. I mean, it's kind of all over the place as far as what the reports were. I think there was only one company that we reported on that talked about a net gain, and that was EXP, and actually gained 1.5 million, I think it was, which led, if you add it all up, it's about $69 per agent.
Interesting. But is that because their sales are increasing, or that's because they actually increased more agents? So
it seems low. Seems low. They actually did increase agents. Matt Lamar says, stop using logic in real estate. Yeah, that's true. And Christina says, if jobs tank, maybe homes will fall suit. That could be. If jobs actually do start to go down, then maybe you see people pull back on their home purchases. And if there's less buyers in the market, then hopefully there would be the prices would start to go down. But
I feel like we've weathered that storm, though, right? All these tech companies that were coming out saying they're laying off all these individuals, but yet the latest CPI report says otherwise. So I'm having a hard time seeing these jobs all of a sudden get lost.
And we're still short like $1.5 million houses in what, not $1.5 million. We're still short something like 1.5 million homes in order to satisfy the current demand. So even if you cut demand in half, you're still short 750,000 homes of what you need to satisfy the current demand.
Yeah, I could go on and on with this one, especially here in California, where we certainly don't favor the builder. So I don't see a way that we're going to build our way out of this inventory crisis that we've been in for quite some time now. So I'm big on the back of overall supply and demand. We don't have enough supply. The demand, to your point, cut the amount of demand in half, and we still don't have enough supply. So
well, maybe that's why builders are so excited. A pivot in real estate. New home construction takes center stage. In the dynamic landscape of the real estate market, there is currently a renewed emphasis on new construction, and the National Association of Home Builders, Wells Fargo Housing Market Index, I think that's the longest report that we quote on the show. It reported that an encouraging 5-point rise to 50 in May. Now, anything over 50 is positive, and this is the closest we've been to 50 in a long, long time. It's the first time we've seen the confidence marker reach this point since July of 2022. This surge of optimism among builders is largely driven by the behavior of existing homeowners, many of whom have chose to retain their properties due to their advantageous mortgage rates. Consequently, new home construction is taking an increasingly crucial role in the market. In March, 33% of homes listed for sale were new construction, which is a significant increase from the average of 12.7%. So almost double as a percentage point of what was listed is new construction. And that the 12.7% was recorded between 2000 and 2019. So this 33% for a year is a significant increase. Despite the buoyancy, the industry continues to grapple with several challenges, including disruptions in the building materials supply chain and tightening credit conditions for residential and real estate development. Even so, the hurdles have not deterred the builders from meeting the growing demand. The reliance on incentives among builders is showing signs of a reduction. That started last fall. I wanted to say we started to see more builders offering some stuff like, hey, we'll pay your closing cost, or hey, we'll give this or that for you. That's slowing down a little bit. As of May, the percentage of builders lowering home prices is at 27%, while the average price reduction remains steady at 6%. More than half of the builders are still offering some type of incentive to maintain sales momentum, but that number is down. In terms of the HMI indices, all three posted gains in May. The current sales conditions index rose 5 points to 56. Sales expectations for the next 6 months climbed 7 points to 57. And the buyer traffic gauge climbed 2 points to 33. So in summary, builders are excited about the current environment and what's going on, which they should be. Even if you cut this stuff in half, we're still way short on the amount of demand we need. I'm sure there's tons of new construction in your area. I feel like it would just be growing constantly.
So I have a unique perspective. I have some relationships, some business ties with some of the local builders here in the community. When somebody goes in to buy one of the brand new constructions and they need to sell their house first, the builders will actually call, and Complete Builder Services is one of the contacts that I have. That's so cool. I have my thumb on the pulse of, and I've been with those guys for probably 8 or 9 years now. Early on in that time, we were doing a ton of business. I mean, 20 to 30 transactions a year just from that one lead source alone. Over the last couple of years, obviously, it's been incredibly quiet. Just recently, over the last, I would say 2 to 3 weeks, we've actually seen leads pick up from that. So people, what that tells me is that builders are willing to accept an offer from a contingent borrower.
Yeah.
Which has not been the case over the last, again, 3-4 years.
Right.
Or So to speak to
was,
your point about building, we feel like there would be building that pops up everywhere. I got to remember we're in the state of California, and we don't make it very easy for builders in our area
oh
to
yeah, I
build.
guess it's true. You got all kinds of taxes and stuff like that to kind of
It's not
red
pretty.
tape.
Yeah, a lot of red tape, I guess, would be the nice way to say it. So, although we do have construction, don't get me wrong. Again, Southern California is a hot spot. A lot of people are still migrating, and I'll speak to that a little bit. Last year was the first year that we actually saw negative migration, more people leaving California than they are coming. That's not true for.
They're fleeing. They're fleeing.
They're fleeing, by a very small percentage.
A lot of them are coming to Arkansas. We're getting a huge influx from the West Coast. Yeah.
Okay.
Not only California, but Washington and Oregon as well.
Again, those stats are true, but not for where I am here in the Inland Empire,
Yeah.
Riverside, San Bernardino counties. We still have more people coming to our area than fleeing. So we still do have a lot of construction. Obviously, certain pockets are booming more than others. We are still seeing incentives being offered by the builder. There was obviously a pause on building. I think years back, 10 years ago, builders used to build phases, right? So they would build 15, 25 houses, and then they would sell them off. Now their model has changed significantly. They sell the house and then they build it. And so I'm not sure.
So pre-solds instead of. That's interesting. So are you seeing, is that changing the like layout of these houses? Are they more unique looking, or is it still like pre-home spec homes?
No, it's pretty well
pre-built
spec.
Okay.
You'll have your small changes on the exterior, the same options that they would offer anyway. But just
that's interesting.
It's, I think it's good though. In all honesty, I think that it's good when you get that standing inventory, and then the dust starts to build, and then you get the vacant houses amongst a brand new community. It kind of has a weird feel to it, almost like a ghost town. When you're
it starts to hurt the people that are trying to empty out of their regular house, not a new construction house. The people that are trying to sell the resale home, that starts to hurt them when there's new construction that's sitting.
Yeah, why is the builder sentiment going? I don't want to say going through the roof, but why is it higher today than it was previously? And it's all the things that we've touched on. Interest rates are forecasted to come down. Yeah. Resale inventory is at like an all-time low right now.
Right.
So even on the back of those two things alone, people are they can't go buy the house down the street that they want to, so they have to go to the new construction. It just kind of makes sense.
Well, I had 2 conversations with people this week that had I had this conversation with them 2 years ago, they would have sold their house and bought a house. But now they're talking to their lenders about keeping their current house because it's basically free money. Their interest rate's in the 2s, and they're like, we're basically being paid to just keep the house. It doesn't matter if we have a tenant in there or not. So we're just going to keep the house and then go buy another one.
So talk about the long-term effects of inventory with exactly what you said. The far majority of people are sitting on a sub 4% mortgage rate, and nobody's going to sell their house. They can rent it out, make positive cash flow, and still afford to go buy the next one down the way. So
well, it used to be, correct me if I'm wrong, old folks in real estate who watch the show, but it used to be that new builds would come in a little bit cheaper than a current home, than a resale home, because they were in newer areas and they're usually on the outskirts, and they were building them for people that were first-time, second-time home buyers. And then those resale homes would be very desirable, a lot of them remodeled, and people would sell those a little higher than some of the new construction. But over the last, I think since 2006, maybe 2007, I believe that trend has changed to where a lot of the new construction is more desirable and is selling over what the resale homes were. But I can remember a time studying real estate back in the day that people were talking about the resale values being more than new construction. So we're in an interesting time period where now that may start to flip again, where you have these beautiful resale homes in very desirable areas, closer into the city, closer into where people work. And then you have the outskirts being built up. I wonder what the sales price of those are going to be, especially, if they control the inventory, like you're saying, and do mainly like pre-built homes, I think that's going to control the inventory a little bit more. But the first person that does a phase, then I think you're going to have some other builders go, oh, we need to phase. Like they're phasing over there. Let's do a phase for us too.
Right. Yeah, I actually wasn't aware of that. So you're talking maybe 18 to 20 years ago.
Long time ago.
Yeah.
Hillary said that's how new builds are in Nashville. But but we're not seeing accepted contingencies yet. So they're seeing the same type of thing where they're building a controlled pre-sold. And then Olivier says that's not going to happen. That's not going to help the supply issues. Talking about people staying in their house because of low rates. Yeah, exactly. So not only, speaking of supply, this is a terrible transition. I mean, you could transition a couple of ways. One is like you have these commercial developers that have been building office buildings and office spaces for years and years. And they're looking over to the residential side saying, wait, 33% of homes sold recently were new construction. They're 1.5 million houses short. Why are we building this office space when there's so much office space all around us? Maybe we should switch gears. So I wonder how many commercial developers are going to switch gears, because the stuff that's going on with the office, there were 4 articles that I found about offices emptying out around the country. And they thought that would end, but it's not. So what are we going to do with all these big office buildings? Let's chat. The Great Office Reimagining, how vacant buildings are morphing into residential spaces. So the COVID-19 pandemic brought a seismic shift in the commercial real estate landscape. A paradigm shift happened across the U.S., with Salt Lake City being a prime example. Despite an upswing in the downtown activity, the city's office buildings echo a nationwide trend, a significant slowdown in the commercial real estate market. Kip Paul, vice chairman of investment sales for Cushman & Wakefield in Salt Lake City, illustrated this stark reality, stating that an office building that would have fetched $350 per square foot 2 years ago recently sold for less than half that amount. 50% off. This was a drastic turn of events and underscores the ongoing real estate slowdown, with office buildings becoming a focal point of this trend. And so if you've been sleeping for the last couple of years, basically what's happening is everyone around the country now works from home, does Zoom calls. And then, so that means that you don't really need your office space like you used to. Well, I guess 6 months ago, companies started recalling workers back into the office, but that didn't go how they planned. A lot of people said, nope, I'm going to find somewhere else to work, because not only when their company said, okay, you guys don't have to work from the office anymore, you can work from home, they didn't just stay in their zip code, in their house, paying super high inflationary fees, where bread was skyrocketing and milk was skyrocketing. They had all these fees. They still had the same job and everything, but why stay there when they could go live in what was traditionally thought of as a second home? They could pay the same price and live on the coast in Florida, or live in the mountains, or live wherever they want and still work from home. So then a year and a half later, the companies say, hey, we're recalling everyone. We want you to come back into the office. And those people are saying, no, I can find another job that'll let me be here. And that's becoming a big problem around the country with the workforce. So Jessica Morn, head of office research for CBRE, stressed the necessity of these transformations into residential spaces. She said, quote, if those buildings remain unattractive and unleased, it's going to continue to weigh on the vacancy rate. Either they're removed from inventory by conversion, demolition, or analysis just completely cut it out because they know it's not really competing with anything else, which is interesting. You have a total vacant space. You're just going to cut it out as a comp. However, not every office building is suitable for conversion. Large floor areas and existing layout complications can make the process expensive and challenging. CBRE's research suggests that only about 30% of buildings are suitable for a residential conversion. Investors are showing a lot of interest in this, acquiring the office buildings and repurposing them to something new. It's a win-win, benefiting both the investors who can turn a profit in the real estate market, which is alleviate high vacancy rates, and this huge problem that we have right now with inventory. Stephen Panter, a principal at Ginsler, an architecture firm specializing in office conversions, captures the situation succinctly. He says, quote, as the value of office continues to drop, the viability of converting to residential increases. As the value of office continues to drop, the viability of converting to residential increases. In any city where there's an older office stock and a strong demand for housing, then it's happening. So this is really, we've talked about converting some old schools into residential places. We've talked about seeing some malls be turned into it. And one of the things that we talked about on the show is like these office buildings seem ideal for that because you just, can go around in the office spaces and put multifamily housing. You could take whole floors and make penthouses and things like that. Are you seeing this in your area? Have there been any office building conversions yet?
Nothing that I've seen, but I absolutely love the idea. Finally,
Yeah.
a solution to our inventory crisis that we're in.
Yeah.
I wasn't aware you guys were talking about the conversion of schools. I actually had that written down out in
Yeah.
Pennsylvania. I saw they converted that old school, 31 units. I think it's fantastic. Again, if they're going to sit vacant anyway, you mentioned a few things in that article that I'm just confused about. If it's vacant, they just won't use it as a comp.
If it's a vacant older building, then analysts will either have to disregard it as a comp, or they'll have to demo it, or they'll have to change it.
Again, we're throwing that logic out the window completely, like I just mentioned earlier. But
yeah,
we want the data to match whatever story we're telling, I think is what we said a few times now. The other question, 30% of those units would actually only be suitable. And I'm confused.
Yeah, 30% of office buildings would only be suitable for the conversion. The other, it would be cost prohibitive currently.
I'd want to look a little closer at that. Get these contractors actually in there to take a look and to really cost analysis the difference there. But again, I think it's a fantastic idea. We're not seeing it, or I'm not specifically seeing it locally. Again, just geography, just to give you an idea, I'm probably 60 miles outside of LA and about 60 miles outside of Palm Springs. I'm basically located right in the middle. So we don't have a ton of office space, at least super locally is where we're at. So
more of a traditional situation for you then.
Say again?
More of a traditional single family home situation for you then.
Correct. We're built on the back of an old military base, March Air Force Base,
cool.
one of the largest non-active bases on the West Coast. But yeah.
Olivier says we actually have our first office building of decent size converting to residential. That's cool. Matt Lamar says, just watch out for the principals that haunt those houses, those halls. I mean, landlords.
Are you seeing this at all where you're at, Ray?
No, not yet. We don't really have any big office buildings that are vacant. There's big bank buildings that have vacant spaces in them, but there's always something in there. I could see some of those spaces being turned in, like having a floor of residential among that stuff. That would work in our downtown area. Our problem downtown is parking. And, there's big developers that are like, oh, we don't want parking decks everywhere. But I mean, then you got to do something. You got to do something to get people to park. But they're like, put parking decks on the tops or bottoms of all these big buildings. So that's the issue.
Changing that stuff to residential would make parking actually better. You don't have the 14, 15 offices on the one floor. Now that's a one penthouse. You have
it could. I don't know how many. I mean, those penthouses though, they're not going to be a huge draw for Arkansas. I don't think.
Well, either way, you're still going to take an office that you would traditionally have one or two people in, and you're converting multiple offices to have one family in. I would assume you're going to have less people in the building overall.
I don't know. That's an interesting thought. Like, how many people were attending that floor before it was vacant while it was still busy. And then how many would be on there if you converted it to residential? I guess it depends on the conversion itself. I think a lot of this conversion may go from, we're thinking people buying apartments or buying condos, townhomes, that kind of thing. But I think what you'll see is a lot of investors buying it and doing multifamily to where it's just renters.
I would agree.
Hey, Ray.
Yeah. What's up,
Jack from Marblehead.
Hey, man. Are you seeing this in your
How are
area?
ya? So I'm about 15 miles away from Boston, and so we have a lot of older buildings. We have a lot of newer commercial buildings, and it was definitely part of the mayoral campaign that finished up last year. But it turned into the reality of how to do it, and I think that 30% number is going to be high. If you look at all of the newer high rises that are for residential use, they're almost like needles that go straight up. And that's because you need windows for bedrooms. You need windows for residential. And when you consider that we're talking about, steel and concrete buildings, it's not easy to just, put a bathroom over there. And so I think that 30% number is high. I don't think however, I don't think we've seen the full, the full effort of the building owners yet.
Yeah.
Because their spaces are still rented. And it's when these leases are going to start coming up and when people start dropping the keys on the counter in the foyer and walk out, that we're going to see some real effort in this regard. And I think those days are coming. I think this is going to be the biggest real estate story of this whole of the whole pandy at the end of the day.
If people have been watching what's going on with the CMBs and what's happening in the commercial, there's a lot of people that bought those loans that, these commercial developers and people that bought these big commercial properties, they're holding them. And there's a lot of talk about what's going to happen in that market, because if these offices don't come back and fill those spaces, then they have to do something. They have to figure it out.
And they're super leveraged.
Yeah.
They're super, super leveraged. And I've said it before, the people that I've talked to in the commercial world and pretty entrenched people in the commercial world are saying that buildings are definitely going to be torn down.
Yeah, you're going to have to. Well, thanks for giving us a little bit of insight into that. But that's interesting. 30% in his opinion would be a little bit high because of all the conversions and changes that you have to do to that. So
I thought it was low in my opinion, but he brought up some really good points. Shout out to Boston, though. They serve those amazing lobster rolls right outside of Fenway. Absolutely.
Yeah, how about those Celtics? Let's go. We took a horse in the race. The Bruins didn't make it, but the Celtics are still alive. So, but thank you, guys.
Yeah, man. Thanks for joining us. Well, so this may be one of the issues that's going to slow down some of that conversion, is that the rent rates people were getting just 2 years ago is drastically different from what they're getting. So renters rejoice. The rental market finally cools down. So the shift of power is on the supply side and it's starting to catch up with demand. Renters are starting to breathe a sigh of relief. To give you some numbers, the median U.S. Asking rent inched up 0.3% year over year to $1,967 in April. This tiny increase marks the 11th consecutive month of slowing growth. So even more interesting, the month-over-month median asking rent actually dropped 0.2%, which is a bit of a curveball given that the rents usually rise during this time of year. So why the cool down? The sheer number of new rentals hitting the market is a significant factor. The residential construction boom over the past decade has led to 60% year-over-year increases in completed residential projects and buildings with 5 or more units. And yeah, for a while, everywhere on Clubhouse, you would join a Clubhouse and they were talking about developing multifamily. So yes, that's been a huge focus over the last 2.5, 3 years. Looking at the geographical breakdown, the Sunbelt region is seeing the most dramatic rent declines. Austin, Texas took the lead with a whopping 14.3% year-over-year decrease in April. Other Sunbelt stars like Phoenix and Las Vegas, I wouldn't call them Sunbelt stars, weren't far behind with declines of 9.6% and 7.1% respectively. On the flip side, Midwestern cities rents climb. Providence, Rhode Island saw 16% year-over-year rise. This might be due to relative affordability in the areas compared to a booming market like Austin and Phoenix. So interestingly, if you were going to convert a big downtown space into a giant rental market, then you have to be nervous looking at what's happening at rents and what Chris and I just talked about. As people are buying the next home, instead of selling the other home, they're renting it out. So you also probably have single family rentals that are going up, and we're still selling homes to investors all over the place who are basically taking those out of circulation and renting them. So the more and more rentals that are available, the lower those rent prices will be. But this is not just for single family rentals. We can also talk about this in the context of short-term rentals. When the rich retreat, the Hamptons overstocked rental market. So this could be a sign of what's to come in more markets around the country. But the Hamptons, once a coveted summer destination for Wall Street's affluent, is feeling the weight of oversupply. There's currently approximately 5,700 summer rentals available on South Fork Peninsula, a figure that doubles the typical inventory pre-Pandy. The surplus of rentals is causing homeowners to slash prices by up to 20% in a race against time to fill their rentals before Memorial Day. However, keep in mind that bargains in the Hamptons are just relative. A standard 3-bedroom house can still set you back about $60,000 to $100,000 for the summer, while oceanfront properties can command over $1 million per month. The rent supply is a ripple effect from the Pandy, which saw mass exodus of wealthy New Yorkers into the Hamptons, culminating in the real estate boom that pushed the median sales price by over 40%. The pendulum has now swung in the other direction. Many of those new homeowners are looking to rent out their properties, either free themselves to travel or to supplement their income. And this surge in supply has disrupted a market that traditionally had limited rentals and consistently high prices. Further complicating the situation is a decrease in demand. The Hamptons economy, tethered to Manhattan and specifically the finance tech sectors, is feeling an impact in declining stock market and a dwindling IPO and capital markets. Wall Street bonuses fell 20% last year, prompting the job cuts from several prominent firms and banks. However, it's not all doom and gloom. The bright spot in the rental market is that it's at the very high end. Particularly oceanfront properties are still in demand, with one property already rented for $2 million per month this summer. That's fun. I want to do that one day. Ultimately, the kind of people who would rent such a place are not as affected by the stock market and job cuts. All right, so let's dive into what exactly is happening to single-family rentals, because it's not just the Hamptons. What we're seeing, and this is what this thumbnail is all about. What we're seeing is the potential devastation of the short-term rental market due to a supply increase from when everyone was displaced and all that jazz. This supply increase was a rush to the secondary markets, right? And as people rushed there, oops, sorry. So I don't know why I had it on Do Not Disturb, but that sure disturbed. So I don't know what I'm doing wrong there. Sorry. So that rush to the market is now creating so much supply that even the Airbnb CEO says, if you own one of those homes, if you own a house for a short-term rental, you are not going to get the margins that you once thought. Now, the CEO of Airbnb says this is great for travelers because people are going to save so much money when they travel. But my first thought was, well, what about all these investors who purchased the property trying to get a specific return on that investment? They're out of luck. So are you in a high short-term rental area or no?
Yes. As I mentioned, an hour outside of Palm Springs, that tends to drive a lot of traffic. Also only about an hour from Big Bear. I know we have a mutual friend, Michelle Calkins. I spoke with her just yesterday, actually, in regards to some of the short-term rental stuff. We're not seeing that as much in our local area. I don't know if we're biased because it's California and people are still kind of flooding this direction for vacations and things like that. I do think that it's going to have an effect. I think that the stats are real. The more inventory you bring to a market, there's going to be slightly less demand for that. To your point, the investors that picked up expecting a certain return, now it's having to be less. I think that that's going to have an effect. I don't think that it's going to be as extreme as maybe the headlines or our thumbnail makes it out to be. But I think it's real.
I mean, it's a good thumbnail, though. I mean, look at that.
It's a great thumbnail. It's great. Yeah. It made me want to tune in. But I truly, I'm also only about an hour away from the desert. So I have a property specifically in Big Bear. So it's up in the mountains, up in Running Springs, technically. I just put a full-time tenant in place about 8 months ago. I chose not to do the short-term rental market. I think for me personally, it seemed more of a headache. I just wanted to kind of set it and forget it. So I think that was just a little bit take on my own business model. I also have a 5-acre parcel out in the desert, out in like the Mojave Desert, and you're getting a lot of people that are heading out that direction as well.
Oh, interesting.
There are more and more of these Airbnbs popping up. So it is an incredibly saturated market. I certainly see that there's going to be some lasting effects of this. I don't think that it's going to be the incredible crash that we're thinking of. I think there'll be a shift. I think some of these people will move over to full-time rentals. And I don't know about your area, but we have an incredible shortage of available rental properties as well. So I think they're just going to have to switch models a little bit.
The ones that are this article says that those that are in the ultra high, those are the ones that are really making it. And I spoke with someone that is kind of an Airbnb expert. I'm not going to mention names because he works with people around the country, but he said the ones that are unique, that have a really unique setup or are thematic or are at a very unique location, those are the ones that will outperform and be at the top every time.
Sure.
The ones that are like in the middle of a subdivision have to really rely on the lack of supply and a lack of other available rental units. So as the build to rents and things like that, as people were buying these, fairly new homes and Airbnb them, that was a great idea. But as more and more people do it, you're not going to get the anticipated return. And we know from, the Airbnbs that I've helped investors buy, we've had the increase of the management fee is going to become an issue. So management fees on those are around 30% instead of 10, just, broadly ranging there. So if you have a 10% fee for a regular residential home versus a 30% fee on the Airbnb, but now your Airbnb margins are starting to crunch a little bit. You're not making what you once thought. That I think there's going to be a lot of pressure on the management to offer some additional services or include some of the cleaning fees or do something to take some of that pressure off of the investor, or else the investor is just going to put it up for sale. And if the investor puts it up for sale, then the manager doesn't have that job anyway. So I'm interested.
I don't think that it's going to provide a lot of extra inventory to the market. I don't think that they're going to put it up for sale. I think that
they can't
going to allow them to be a rental.
We just talked about the long-term rental pressure, though.
Again, it's all location, just like anything in real estate. So certainly not true for our local area. Again, I know we're kind of speaking to a national crowd right now. But you definitely have to pay attention. And depending upon where you are, to your point, when you have an oversupply of any inventory like that, now you have to focus more on curb appeal. The house has to look better. It needs that fresh paint job. So if you're looking at the short-term rental market, to your point, yes, it needs to be unique. It needs to have some features that are going to draw the crowd to it.
How would we crash it? That's a different way of asking the question, right? Not how would it crash. If we're going to crash it with these last 4 articles that we talked about, builders being excited to build more property, right? So that's going to take some pressure off of inventory. People are going to move, buy houses. Maybe you'll see some people build to rent. So people are going to buy houses. The multifamily complexes going into commercial areas, that's going to be densely populated, very popular for short-term rentals because of their location right in the city. It's going to be very popular for long-term rentals, or maybe even for people to purchase. So this working together, builders and these big commercial things that may be developed, taking pressure off of residential real estate, taking pressure off of rents. We're already seeing rent drop. So, the increase is not as high, right? So it's not dropping, but it's kind of flatlining. And so if that stays flatlined for a couple of years, then investors aren't going to make the same rent increases that they have been making over the years. So now you have somebody in a short-term rental on the coast that is near all these other properties that are also short-term rental. And then you have condos that are there that some of those don't even allow short-term rentals. So those are, you have to have your timeshares and all that stuff in there. So I think the way to crash it would have to be, it would be difficult. It would have to be an oversaturation of desirable short-term rental locations.
Right.
That's how you crash it.
Which I don't see happening. I don't see that happening in a big way.
And if it's not a desirable short-term rental location, then you should be able to purchase it and rent it out long-term and cash flow. If it's a desirable short-term rental location, you can't purchase that and cash flow it for a year rental usually, right? That's not going to work because your purchase price was too high because they're thinking either short-term rental or you're going to buy it and stay there, own it outright. So that purchase price is too high. It's too desirable a property. It's probably not going to rent year over year for what you need it to. So that would be, I think you're right the Airbnbs like in the middle of a subdivision, those turning into long-term, which then eases the supply on Airbnbs.
That's, again, all the factors that you just laid out. We would need a combination of 3 of the articles that we talked about that would influx that inventory. But talk about timing. When did these people buy these Airbnbs? And most of that was happening over the last 2 or 3 years.
Yeah, when prices were at the all-time high. Interest rates were down. So
Interest
you're
rates
right.
Down, and it will
the debt
cash
service
flow
is not
today.
much. Yeah.
We're not seeing a pullback in property value. So that home is worth more today than it was 3 years ago. So again, their business model of wanting to be a short-term rental, they also made money on the equity of the home. And so I think they could easily put long-term renters in there. And just like you said, it would still cash flow. So it's an investor that picked it up. So maybe the plan A of investing didn't work out, but they still have a fallback. And then thirdly, plan C is that they would likely sell the home at that point. So I see it being a long-term problem. I fly out to Tampa Bay tomorrow just for a little vacation. I have 2 different Airbnbs that we're staying in. I'm a user everywhere we go. The last time I saw you in Dallas.
He's a user, everybody.
I'm a user.
Well, speaking of where you're flying to and from, thanks everybody for joining the show. Tell everybody again where they can find you and catch up with you.
Chris Leeper, Southern California. You can find me on Instagram at Agent Leeper.
Agent Leeper, and it's Leeper, not Leap. And you guys can find me at Razorback. That's Rayzorback. Thanks, dude, for joining me. I appreciate you being my co-host today.
You're welcome. It was good hanging out with you, my man.
All right, bye, everybody. We will